Hello and welcome to this week's Fit Finance sessions. And this week we're going to talk about something that we haven't spoken about for at least 15 minutes, and that is inflation. And I'd just like to point out we have been saying this would occur for the last, I don't know, as long as we've been doing this podcast, really, since the pandemic. But I think we're definitely starting to see inflation appear in the real world now, rather than just us talking about it theoretically. So Henry, do you want to go first and say your sort of bit about where you're seeing inflation, what's occurring there, and then I'll come over to Tim shortly.
Yeah, I mean, yeah, I'd love to. Thanks. I suppose the fact that we are seeing this because I've seen it on the Telegraph website just this morning, and that is that the Eurozone is now pushing through inflation numbers of around 4%. And in truth, Bank of England was explaining that UK inflation was up at 2.5%. The bank's target level for inflation is 2%, and as they move, I think it's a 1% over, isn't it? The governor of the Bank of England has to write to the Chancellor to say sorry and please, sir, it's okay, don't worry about it. My guess is that inflation in the UK has still got some way to run. I mean, we're only just coming out of the back of the pandemic now. And I would expect that if you think back this time last year, of course, actually we weren't locked down, but actually things started to tighten up again, didn't it, towards the end of last year, and then we were back into another lockdown over Christmas. And so I think it's reasonable to expect that over the rest of the year, we will see more inflation. Oil prices are now back up at $60 a barrel. People are finding it hard to employ people, and so wages are being shifted up in a way that they haven't been for some time. And of course, underlying all of this, borrowing rates remain very low. So the cost of mortgage debt now, regularly you can source deals for under 1%, which is extraordinary. But of course, for people remortgaging the same value of debt, that just means they now have more money in their pocket to either to pay the mortgage or, more frivolously, as I would do, to go and spend on fun things. But also, of course, it then drives the value of housing up because people can borrow more, and so they can buy bigger houses or houses with more bedrooms for studies and what have you. So it's an interesting thing that we're seeing inflation coming in from lots of different sources. And I suspect that we've still got another year or so of it to run before the pandemic and the COVIDness is worked out of the system. And it'd be interesting to see then, maybe Tim will talk about this, but what happens to interest rates given the underlying inflation, and how does the Bank of England start to combat it, or does it just say, actually, you know what, it is going to run, but it will run out, and in a year's time, inflation will come back down to 2% without us doing anything. And that I'm not entirely sure of what the answer will be.
Tim, what's your view, and also what are those inflation expectations doing to markets?
Well, markets at the moment, typically stock markets like that are kind of just ranging, to be honest with you, particularly the FTSE. We're sort of bouncing around 771, tipping below a little bit, but broadly speaking, it's just sort of sitting on the fence, much like the banks seem to be with regards to interest rates. So, and yeah, coming on from what Henry was saying with regards to inflation, higher inflation, typically then we'd expect interest rates to come up to sort of, take the boil off a little bit of the economy. But I suppose, I mean, many moons ago, again, from one of the conversations we've been having about this, we said, didn't we, it was the idea of whether or not some of these inflationary signs that we're seeing are transitory or not. So perhaps that's what, as the banks are thinking, saying, just remain cool, calm, it'll pass type of thing. Yeah, as Henry says, we may see a little bit more from where we are at the moment, but again, that will sort of taper off as COVIDness, as Henry quite rightly puts it, sort of bleeds out or whatever. We sort of more officially get to the other side of what we're still arguably going through at the moment. Really, it comes down to what the Fed's going to do. What the Fed and what the bank's going to do. Really, I see it as particularly with the US market, the US stock market is just continuing on its seemingly unstoppable bull run, and it's kind of a situation where if the Fed do nothing, then that'll continue. But if they do raise interest rates, then we're going to see a big pullback. And actually, there was a Reuters poll today, I think it was actually, or at least in the last couple of days, of sort of a good bunch of fund managers out there, and there's a slim majority saying that by the end of the year, then potentially we may start to see that in the markets come down in some shape or form. But hey, things are yet to be seen, and at the moment it is sort of just moving sideways.
Yeah, there's definitely people in different camps. I think central banks are saying it's transitory and will get fixed, because I think some of these inflationary pressures are supply chain issues and other bits, but then equally I don't think it's all that. It's like Henry was saying, it's coming from all areas, and markets will be fine longer term. And we've sat here said many a time it's better to be holding equities longer term to deal with inflation. But I think some of those companies, particularly with borrowing costs, if they start to see higher interest rates because of the inflation, then that hurts their longer term expectations. But I think it's also interesting to look at what data is being used to depict the inflation as well. It might be 4% inflation, but that's based on a basket of goods. Housing is definitely not included in a lot of those figures, and you've seen massive house price inflation. But also, I think you're seeing inflation in reduction of the size of things. I can barely make a tuna sandwich with the tins of tuna now. Everything's just getting increasingly smaller. But I think there's definitely some strong views. I think if you're paying attention to Michael Burry, who keeps getting banned off Twitter because of his doom and gloom around inflation, but he did predict the 2008 crash, if anyone's seen The Big Short. But he's been very vocal about inflation. Warren Buffett's been very vocal about inflation. So there's a lot of people in the investing world saying inflation is here and back with a bang. But then there's lots of central government saying, don't worry, it's only transitory. But equally, those central banks have just issued a load of debt and would quite happily have a load of inflation. So there's the cynical view, as always, from me. But yeah, I think markets will generally keep going. It's just at what pace. I don't think we're going to see anything too crazy in either direction. But yeah. Anything else to add, chaps?
Very concise and informative as ever, I think, Tom.
Beautifully packaged.
Yes, lovely.
That's what they always say about me. Okay, well, on that note, we will reconvene in a short while next week to talk about probably inflation again. Until then, see you later. Bye.
Bye.